The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. It can tell you how a company can maximize the current assets on its balance sheet to satisfy its current debt and other payables. The current ratio is used to evaluate a company's ability to pay its short-term obligations, such as accounts payable and wages. It's calculated by dividing current assets by current liabilities. The higher the result, the stronger the financial position of the company usually. Small business owners should keep an eye on this ratio for their own company, and investors may find it useful to compare the current ratios of companies when considering which stocks to buy. The current ratio, less commonly called the working capital ratio, compares the assets of a company that it can convert into cash within a year with the liabilities it must pay off within a year. It's one of the few liquidity ratios, including quick ratio or acid tests, and the cash ratio that measures a company's capacity to use cash to meet its short-term needs. On the balance sheet, current assets include cash, cash equivalents like investments that mature in 3 months or less, and are easily converted into cash, such as government bonds, commercial paper, and money market funds, accounts receivable, and inventory. Current liabilities include accounts payable, income tax payable, wages payable, and dividends declared, which are respectively amounts owed to suppliers, income taxes owed to the federal government, employee wages earned but not yet paid, and dividends approved and declared by the board of directors but not yet paid. The current ratio is calculated simply by dividing current assets by current liabilities. The resulting number is the number of times a company could pay its current obligations with its current assets. I'll show you how the current ratio works with an example of the current ratio formula for a company called Business A. Business A holds 20 million in cash, 30 million in marketable securities, and 50 million in inventory. On the other side, it's got 40 million on short-term debt and 45 million accounts payable. So what we can do is current assets is going to equal the 20 million plus the 30 million plus the 50 million, and that equates to 100 million. Current liabilities is going to be the 45 plus the 40, which is going to equal 85 million. So the current ratio is going to be the 100 million divided by the 85 million, which comes out as 1.2. So business A has a current ratio of 1.2. This means that it has the ability to settle each dollar on loan or accounts payable. A rate of more than 1 suggests financial well-being for the company. There is no upper end on what is too much, as it can be very dependent on the industry. However, a very high current ratio may indicate that a company is leaving excess cash unused rather than investing in growing its business. A current ratio of less than 1 means the company may run out of money within the year unless it can increase its cash flow or obtain capital from investors. A company with a high current ratio has no short-term liquidity concerns, but its investors may complain that it's hoarding cash rather than paying dividends or reinvesting the money in the business. A current ratio that's in line with the industry average or slightly higher is generally considered acceptable. A current ratio that's lower than the industry average may indicate a higher risk of distress or default. Similarly, if a company has a very high current ratio compared to its peer group, indicates that management may not be using its assets efficiently. Two items that are often used when calculating current assets are not easily converted into cash: accounts receivable, money other companies owe the company in question, and inventory, completed products and materials used to create them. For that reason, the current ratio may not be the best measure of a company's short-term liquidity. This is one of the limitations of the current ratio. The cash ratio replaces current assets with only cash and cash equivalents, the most liquid assets a company can own. So it eliminates the potential liquidity problem associated with inventory and accounts receivable. A current ratio calculated for a company whose sales are highly seasonal may not provide a true picture of the business's liquidity, depending on the time period selected. That's also something to keep in mind.